Imagine it is March 14th, 2023. You are a 52-year-old high school math teacher living in Sacramento, California. You have done everything right, or at least everything you were told was right. You have a modest 3-bedroom house you bought in 2009 at the bottom of the housing crash. You have a state pension that you have been paying into for 26 years. You have about $90,000 in a 403B retirement account, most of it sitting in what your financial advisor called the safest investment on earth: United States Treasury bonds, government bonds, the kind of asset that your parents told you was as solid as the ground beneath your feet. Every month you check your balance, and every month it has barely moved. You sleep well because of this. You tell your colleagues at lunch that you are not one of those people gambling in the stock market. You own the debt of the most powerful government in human history. What could possibly go wrong? If you have ever wondered why the so-called safest investment in the world can quietly destroy the savings of millions of people without a single headline warning them first, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened before in different countries, in different decades, and it always ends the same way. The bond market does not crash the way stocks crash. It does not make noise. It bleeds slowly, invisibly, until the damage is already done. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now here is what our teacher in Sacramento did not know. On that very day in March 2023, Silicon Valley Bank was collapsing. And the reason it was collapsing had almost nothing to do with risky tech bets or crypto or fraud. It collapsed because its balance sheet was loaded with U.S. Treasury bonds and mortgage-backed securities that had lost so much value so quickly that the bank could not survive a single day of heavy withdrawals. The bonds were supposed to be the safe part. They were the thing that killed it. Within 48 hours, the second largest bank failure in American history was complete. And within the same week, Signature Bank followed. Then First Republic. Then a wave of regional banks started trembling. Our teacher did not lose his house. He did not lose his pension that month. But something shifted beneath him, something most people still have not noticed. The value of his bond portfolio had quietly fallen by nearly 18% over the previous year. That $90,000 was now closer to $74,000. Nobody called. Nobody sent a warning letter. The loss just sat there, hiding in a quarterly statement he had not opened. This video is about the bond market, not the stock market, not crypto, not housing, the bond market, the largest financial market on the planet. And it is about why the crisis building inside it right now has the structural ingredients to make 2008 look small. Not because I am predicting the future, but because the historical pattern that precedes bond market crises has shown up before, and what followed was devastating every single time. Before we go further, there's something important to understand. Most people have no idea what the bond market actually is. They hear the word bonds, and their eyes glaze over. It sounds boring. It sounds safe. That is by design. But here's the simplest way to think about it. A bond is a loan. When a government or a corporation issues a bond, they are borrowing money from you. In return, they promise to pay you back with interest over a set period of time. The United States government has been doing this for over 200 years. Countries around the world do the same. The global bond market is estimated at over $130 trillion. That is not a typo. 130 trillion. That is more than 3 times the size of the entire global stock market. Imagine the economy as a building. Stocks are the windows. Everyone looks at them. Everyone notices when they crack. But bonds are the foundation. They are the concrete and the steel beams holding everything up. When stocks fall, people panic. When bonds fall, the building itself starts to tilt. And here's the part most people never learn. Bond prices and interest rates move in opposite directions. When interest rates go up, existing bonds lose value. Think of it like this. You loan someone money at 2% interest. Now the going rate is 5%. Nobody wants your old loan anymore. Its value drops. You are still getting paid, but if you need to sell the bond before it matures, you will sell it at a loss. This one mechanism, this simple seesaw between rates and prices, is the fault line beneath every bond crisis in history. And right now, that fault line is under more pressure than it has been in over 40 years. This brings us directly to the first major chapter of this story. And it starts not in America, but in Britain. In September 2022, the United Kingdom experienced something that most people outside of finance never fully understood. It was called the gilt crisis. Gilts are simply British government bonds, the equivalent of U.S. treasuries. And in the span of just 4 days, the British bond market nearly collapsed. Here is what happened. On September 23, 2022, the new Prime Minister, Liz Truss, and her Chancellor of the Exchequer, Kwasi Kwarteng, announced a mini-budget that included £45 billion in unfunded tax cuts. Unfunded means the government was going to cut taxes without explaining how it would pay for the gap. The bond market responded instantly and violently. The yield on 30-year gilts, which is effectively the interest rate the British government has to pay to borrow money for 30 years, surged from around 3.5% to over 5% in just a few days. That does not sound dramatic until you understand what it triggered. Across the United Kingdom, pension funds had been using a strategy called liability-driven investing, or LDI. In simple terms, these pension funds had borrowed against their gilt holdings to boost their returns. It was supposed to be safe because gilts never moved that fast. But when gilt prices crashed, the pension funds received margin calls. A margin call means someone is demanding you put up more money immediately, or they will start selling your assets for you. Pension funds, managing the retirement savings of millions of ordinary British workers, were suddenly hours away from insolvency. The Bank of England had to step in with an emergency bond buying program worth £65 billion to stop the cascade. Let that sink in. The central bank of one of the world's largest economies had to perform an emergency rescue of the bond market in the span of a single week. Liz Truss lasted 45 days as Prime Minister. Kwarteng was fired within 3 weeks. But the real story, not about politics. It was about how quickly the supposedly safest asset in a country's financial system can become a weapon of mass destruction. The ordinary people in this story, retired teachers, nurses, firefighters, municipal workers, most of them never knew how close their pensions came to evaporating. The floor did not collapse, but the cracks spread deeper than anyone publicly admitted. This leads to the second part of this story, and it takes us back further in time and across the Atlantic. Here's something I want you to think about before we go further. If government bonds are supposed to be the safest investment in the world, why have they caused some of the most catastrophic financial crises in history? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. And it changes everything. In December 1994, the bond market nearly brought down Wall Street. It is called the Great Bond Massacre of 1994, and almost nobody remembers it. Here's the context. In early 1994, the U.S. Federal Reserve, under Chairman Alan Greenspan, began raising interest rates after a long period of keeping them low. Rates had been at 3%, a historically low level at the time. Between February 1994 and February 1995, the Fed raised rates 7 times, taking them up to 6%. The bond market was caught off guard. Investors, banks, and hedge funds had loaded up on bonds and bond derivatives during the low-rate era, betting that rates would stay low or go lower. When rates surged, bond prices fell hard. The Bloomberg U.S. Aggregate Bond Index lost roughly 2.9% that year, which was its worst annual performance in decades. But the real carnage was in leveraged positions. Orange County, California, one of the wealthiest counties in the United States, declared bankruptcy in December 1994. Its treasurer, Robert Citron, had invested the county's money in complex bond derivatives using heavy leverage. When bond prices dropped, the county's investment pool lost approximately $1.7 billion. Schools, libraries, and public services were slashed. Workers were laid off. The county had to borrow over $1 billion just to keep functioning. And Orange County was not alone. Across Wall Street, firms reported billions in bond-related losses. Kidder Peabody, major investment bank, collapsed partly due to bond trading losses and was absorbed by PaineWebber. Mexico, which had been issuing dollar-denominated bonds to attract foreign investment, saw its bond market implode at the end of 1994 in what became known as the tequila crisis. The peso lost nearly half its value. Mexico required a $50 billion international bailout, the largest in history at that time. Ordinary. Mexican families saw their purchasing power cut in half almost overnight. The price of basic goods doubled. Small businesses that had borrowed in dollars were wiped out. The mechanism was the same. Interest rates moved. Bond prices moved in the opposite direction. And everyone who had built their financial life on the assumption that bonds were stable and boring discovered that boring can become terrifying faster than anyone expects. Now, here is where it gets interesting, because the third chapter of this story takes us to a place most people would never associate with a bond crisis. Japan. In 2022 and 2023, Japan experienced what many economists called the quiet crisis. For decades, the Bank of Japan had been buying government bonds in enormous quantities to keep interest rates near zero. This policy, called yield curve control, meant the central bank would buy unlimited amounts of bonds to prevent the interest rate from rising above a certain level. By 2023, the Bank of Japan owned more than half of all outstanding Japanese government bonds. Think about that for a moment. The central bank of the world's third largest economy owned more than half of its own country's debt. It was like a restaurant, reviewing its own food. The system only worked as long as nobody questioned it, But in December 2022, the Bank of Japan slightly widened the band it would allow interest rates to move within. It was a tiny adjustment of a percentage point. The bond market reacted as if a dam had cracked. Japanese government bond yields spiked. The yen, Japan's currency, had already fallen to a 32-year low against the dollar earlier that year. Japanese importers were paying far more for everything from oil to food. Ordinary Japanese families, already dealing with wages that had barely grown in 30 years, saw their cost of living rise meaningfully for the first time in a generation. And here is the part that connects Japan's story to the rest of the world. Japan is the single largest foreign holder of United States Treasury bonds. As of mid-2023, Japan held approximately $1.1 trillion in U.S. Treasuries. If Japan needs to sell those bonds to defend its own currency or stabilize its own bond market, the selling pressure hits the U.S. bond market directly. It is like a row of dominoes stretching across the Pacific Ocean. When one tips, the vibration travels. Japanese life insurance companies and pension funds, which hold massive quantities of both Japanese and American bonds, began shifting their portfolios. Selling accelerated quietly, and the effect rippled into every corner of the global financial system without most people ever noticing. The surface of the water was calm, but underneath, the current was already pulling. Most people will never know what you now know. Most people will keep trusting systems they do not understand. They will keep believing that the word safe on a financial product means the same thing as safe in everyday life. If you are still here, you're not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. Now observe what all of these cases have in common. The United Kingdom in 2022, the United States in 1994, Japan in 2022 and 2023. 3 different countries, 3 different decades, 3 different political systems, but the same underlying mechanism every single time. Step 1. Interest rates are kept low for an extended period. During this period, governments, banks, pension funds, and ordinary investors load up on bonds and bond-based products because they appear safe and stable. Step 2. Debt levels rise because borrowing is cheap. Governments run larger deficits. Corporations issue more bonds. Financial institutions build leverage strategies on top of bond holdings because the volatility is so low that it seems like free money. Step 3. Interest rates rise, either because of inflation, policy changes, or market forces. Bond prices fall. Step 4. The losses cascade. Leverage positions unwind. Margin calls hit. Institutions that were considered rock solid suddenly need emergency help. And step 5. Ordinary people, the ones who were never told about the risks hiding in the foundation, bear the heaviest cost. Every time. The mechanism is not complicated. A child could understand it. Money was cheap. People borrowed too much. Then money got expensive. And everything built on the assumption of cheap money started to crack. It is not a fire. It is a flood in slow motion. By the time you see the water at your door, the damage underneath your house has already been done. And this is where history gets uncomfortable, because the question of who gets hurt the most is not a mystery. It follows the same pattern in every bond crisis across every country. The people who get hurt the most are the people who trusted the system the most. Middle-class savers, pensioners, small business owners who relied on stable borrowing costs, municipal workers whose retirement funds were managed by institutions chasing yield in the bond market. In the UK gilt crisis of 2022, it was pension funds serving ordinary workers that nearly collapsed. In Orange County in 1994, it was public employees and taxpayers who paid the price for a treasurer's leveraged bond bets. In Japan, it is retirees living on fixed incomes who have watched their purchasing power erode as the currency weakened and import costs rose. During the 2008 financial crisis, which was triggered not by government bonds but by mortgage-backed bonds, the Federal Reserve estimated that American households lost approximately $11 trillion in wealth. 11 trillion. Home values collapsed. Retirement accounts were gutted. Unemployment hit 10%. The recovery, measured by the time it took median household wealth to return to 2007 levels, took over a decade for most families. And here is the part that stings. In every one of these crises, a small number of people not only survived but thrived. In 2008, hedge fund manager John Paulson made approximately $15 billion betting against mortgage bonds. During the 1994 bond massacre, traders who had positioned for rising rates made fortunes while Orange County went bankrupt. During the UK gilt crisis, certain macro hedge funds that had shorted British government bonds profited enormously in a matter of days. This is not to say these people were villains. Many of them simply understood the mechanism. They understood that when a system is built on an assumption and that assumption breaks, the system breaks with it. They did not predict the future. They recognized the pattern, and that distinction matters. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. Now let me be clear about something. This is not financial advice. I'm not going to tell you what to buy or sell. But the historical record reveals certain characteristics that people who navigated bond crises successfully tended to share, and those characteristics are worth understanding. First, they understood duration risk. Duration is a measure of how sensitive a bond is to changes in interest rates. In plain words, the longer the bond, the harder it falls when rates rise. A 30-year Treasury bond can lose more than 20% of its value with a 2 percentage point rise in interest rates. A 2-year bond might lose less than 4%. People who survived bond crises historically held shorter. Duration bonds, or no bonds at all during periods of rising rates. They did not need to predict the exact timing. They simply recognized that when rates had been at historic lows for a prolonged period, the risk was skewed in one direction. Second, they diversified across asset classes that respond differently to rising rates. Hard assets like real estate, commodities, and certain equities have historically performed differently than bonds during inflationary periods. In Weimar, Germany in 1923, when hyperinflation destroyed the value of fixed income investments and cash, people who owned physical property, farmland, or foreign currency retained their purchasing power, while those holding government bonds and savings accounts lost everything. In the United States, during the inflationary 1970s, when bond returns were negative after adjusting for inflation, real assets like gold rose from $35 an ounce to over $800 an ounce by January 1980. Third, and perhaps most importantly, the people who survived these periods were the ones who questioned the consensus. When everyone around them was saying bonds are safe, rates will stay low, the government will not let anything bad happen, they asked a simple question: what if they are wrong? That question, asked sincerely and followed by action, was the dividing line between those who were protected and those who were exposed. Not brilliance, not insider knowledge, just the willingness to look at historical patterns and take them seriously. Now let me bring you back to Sacramento. Our 52-year-old math teacher, here's what happened to him over the following year. He did eventually open that quarterly statement. He saw the losses in his bond fund. He called his financial advisor, who told him not to worry, that bonds always come back if you hold them to maturity. And technically, that is true. If you hold an individual bond until it matures, you will get your principal back, assuming the borrower does not default. But our teacher did not hold individual bonds. He held a bond fund, which is a pool of bonds constantly being bought and sold. Bond funds do not mature. They do not have to come back. If interest rates stay elevated, the losses in a bond fund can persist for years. By early 2024, his account had recovered slightly, but it was still below where it had been in 2021. Meanwhile, the interest rate on his mortgage, which he had refinanced at 2.8% in 2021, was now far below the prevailing rate. His house was worth less than it had been at its peak because higher mortgage rates had cooled the housing market. He was not in crisis, he was not bankrupt, but he was poorer than he thought he was. And the system that was supposed to protect him, the system of safe assets and professional management and government backing, had quietly failed him in a way that nobody would ever call a crisis. That is the nature of a bond market crisis. It does not explode, it erodes, it is not a fire, it is rust. By the time you see it, the structural damage has already been done. The global bond market today sits at a crossroads that history has seen before. The United States national debt has surpassed $34 trillion as of early 2024. The interest payments alone on that debt are now approaching $1 trillion per year, more than the entire defense budget. The Congressional Budget Office projects that interest costs will exceed $1.4 trillion per year by 2034. The Federal Reserve raised interest rates from near zero to over 5% between March 2022 and July 2023, the fastest tightening cycle in over 40 years. The unrealized losses in the U.S. banking system from bonds that have fallen in value were estimated at approximately $680 billion as of late 2023, according to the FDIC. Those losses are sitting on balance sheets right now, quiet and unresolved, just as they were at Silicon Valley Bank before the music stopped. Foreign holders of U.S. debt, including China and Japan, have been gradually reducing their treasury holdings. China's holdings fell from a peak of approximately $1.3 trillion in 2013 to around $770 billion by late 2023. That is a reduction of over $500 billion. Someone has to buy the bonds that foreign governments are no longer buying. And if buyers demand higher interest rates to compensate for the risk, the cycle feeds on itself. Higher rates mean higher interest payments. Higher interest payments mean more borrowing. More borrowing means more bonds. More bonds mean lower prices. Lower prices mean higher rates. It is a spiral. And history shows that spirals, once they begin, do not politely reverse themselves. I am not telling you what will happen next. Nobody can. But I am telling you what has happened before, in country after country, across decades and centuries, when the conditions looked like this, when debt levels were this high relative to the size of the economy, when interest rates had been artificially suppressed for this long, when the assumption of safety had been baked this deeply into the system. The pattern does not guarantee an outcome, but it demands attention. And the people who paid attention historically were the ones who still had choices when everyone else was out of options. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. They will hear the word bonds and move on. They will assume that if it were really this serious, someone in charge would be talking about it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.